Welcome everyone. Just give people a couple more moments to log on here. Okay, good morning everyone, and good afternoon as well. Welcome to Canada's State of the Market 2025. We're excited to be back to provide another national update on the Canadian real estate market. I'm Alice Dale, Senior Director, Valuation Advisory here at Altus Group, and I will be hosting today's webinar. We have over 4,000 people joining us today after receiving a record number of registrants coast to coast. I think this really does speak to both the resilience and commitment to this industry. We've all survived a fairly prolonged period of turbulence, and we'll see today that 2025 is perhaps best characterized as a year of relative stability. Nevertheless, the year has been marked by several major headlines, anything from Trump tariffs, return to work mandates, and even the shutdown of an iconic national retailer. Here to help us go beyond these headlines through our data-driven insights are my distinguished colleagues, Peter Norman, Vice President and Economic Strategist, Ray Wong, Vice President, Data Solutions, and Rob Santilli, Director of Valuation Advisory. Peter will kick off the presentation with a look at the Canadian macroeconomy and provide some observations on the housing market. Ray will then share his outlook on the commercial real estate market, and Rob will take us through Altus's Canadian valuation data set. At the end, I will rejoin to facilitate a brief Q&A, and speakers will have the ability to answer some of your questions. That leads me to a couple housekeeping items. If you have any questions you would like us to address during our Q&A, please submit them in the Q&A box. We'll see how many we can get to, and if we don't get to yours, we will make sure to reach out post-webinar. Everyone who registered for today's event will receive an email with a link to view the recording, so stay tuned for that later this week. And finally, before I turn things over to Peter, I'd just like to take a moment to highlight something that we're really looking forward to this spring. Altus Connect is taking place April 13th to 15th at Terranea Resort on the beautiful Southern California coast. This event's a great opportunity to connect with hundreds of CRE regulators, explore how data and tech are transforming the way we invest, operate, and drive performance. Attendees of this conference can also see how Argus Intelligence is evolving with the new Canadian data integrations. This will connect insights from Data Studio and unlock future capabilities in fund modeling, debt management, and more. And now, please welcome Peter Norman.
Well, thank you very much, Alice. That looks like an interesting session out in California, so we'll put it on our calendar. And thank you very much to everybody for joining us for another State of the Market webinar from Altus Group. Really pleased to be able to have this opportunity to present some of the things that we're watching right now, a little bit of a review, a little bit of forecast going forward, and definitely interesting times out there, definitely interesting times. I'm going to get right into it now and try and provide some macro context for some of the more detailed real estate findings that we're going to be talking about as the webinar goes on. This year has definitely been a year that has transpired differently than what we were expecting. The turbulence to the Canadian economy from the rapidly changing policy environment, particularly with respect to tariffs and other matters from the United States, have been of concern, of primary concern. Not just about those of us who are looking at the market and trying to figure out where we're going, but also about everybody else as well. Essentially, right now we're in a pretty kind of a soft landing, a low, steady economic growth environment. And punchline, we expect things to kind of pick up modestly as we go into next year. I'm going to start off, though, by just talking about the way that the outlook has kind of transpired through this year. We're probably going to have about 1.2% GDP growth this year. That's a soft landing. That's not a tremendous print, but it isn't a recession either. And it does speak a little bit to the kind of resilience that this economy has had despite all of the chaos and in spite of all of the disruptions this year. And to give some sense about how we're coming forward, we had originally thought this year would grow at about 2%. So it is definitely a little more than, half the pace of what we were expecting. At the beginning of the year, we were saying about 2%. But when I look at the major forecasters, everybody revised down their forecast really rapidly in the spring when a lot of the chaos started happening from the policy perspective. And a lot of that hasn't really come to fruition, not in kind of, real economic sense. There certainly are certain sectors that have been impacted, but in many ways, a lot of sectors have not. I think what's characterized the economy of Canada and in fact broader economy around the world has been this kind of what we're calling kind of an outlook haze or an economic haze that has put people on the sidelines. It has put businesses on the sidelines in terms of making investment decisions. It's put consumers on the sidelines to some extent. I'll get into that a little bit more in more detail about making major purchase decisions. But in fact, as the economy has evolved through this year, those dire predictions earlier in the year have kind of, started to get revised up. Now that's a case for Canada, and you can see that on the right-hand side. And I've even put a kind of a view of the world economy on the left-hand side and putting up the forecasts from the IMF to just show that they have also evolved their understanding about the way that the economy is transpiring this year, such that the world economy probably isn't in the end going to be that affected by the Trump tariffs, at least not this year. They're now calling for about 3.2% growth, very close to what they were calling for at the beginning of the year. So the haze is starting to clear, and that's good news going into 2026. It's not fantastic news because there still are the tariffs. There still are, possibly changing policy environment going forward, but the haze has cleared, and that's probably pretty good news overall. Drilling into Canada a little bit, everyone's fairly concerned about interest rates, and we have been through this major interest rate cycle, and we have seen, of course, starting in about the beginning of last year, this unwinding cycle of this major interest rate cycle. This year, we didn't see a lot of changes through much of it, but we did see a change last month. We may see a change next week or maybe next month, but I expect to have one more change between now and the first quarter, and we'll see when that comes. I think probably not next week, but probably sometime between now and the beginning of next year. And then I think the Bank of Canada is kind of on hold, and I'll speak about that a little bit more as we go forward. There will be some pressures to cut further, I think, from the Bank of Canada's perspective. One of those being that the bond yield continues to be relatively elevated right now, and there may be, a continued pressure right now to alleviate to loosen up the monetary conditions even further in order to loosen up that market. Also, some of those pressures will come from south of the border, where we likely will see a couple more cuts going into next year. We will see a bit of more of a loosening cycle as the U.S. economy slows slightly going into 2026. One of the pressures, of course, has always been where we are on the inflation cycle. We've come through a very major inflation cycle. I've got some different stages of that cycle illustrated in front of you right now about how it has transvolved. But the most important takeaway right now is that we are, in Canada at least, in a substantially stable inflationary environment. We're substantially within the normal range, what I like to call the normal range, that doesn't automatically incite policy changes and also is relatively stimulative to the economy. We don't like inflation to get too low, like below 1%, and neither does the Bank of Canada. And we don't like inflation to get too high, above 3%. and neither does the Bank of Canada. We're in that kind of normal range. Now, you may be aware, some months it ticks up a little bit, some months it ticks down a little bit. Just yesterday, we got an announcement about it ticking up a little bit. Some of that was driven by, continued inflationary pressures on food, but it's offset by a number of, stable or declining deflationary pressures on other segments. And so we'll see how that will evolve, but my expectation is it will continue to evolve within that kind of normal range. A lot of people think that the tariff environment has added a lot to the inflationary pressure, and it probably has on certain segments, of course, but we don't actually right now face a lot of tariffs in Canada through all of the chaos. The TD Bank has said recently that the effective tariff rate is only around 3% right now, not materially up from where it was before. I mean, some segments, obviously, steel and aluminum, et cetera, it's high. But overall, in terms of the consumer basket, it's not we do have some flow-through tariffs that are affecting things like food, but generally speaking, we're in a stable environment, and I don't expect that this is going to, prompt, for example, the bank holding off cuts or even raising interest rates just because we're moving up into that 2 to 3% range. And then moving on to the consumer, I like this chart quite a lot because, I said off the top that consumers may be pausing some of their activity in the market right now, and I still think that is, perhaps true. But it's essentially the consumer has been relatively active this year. Some months up, some months down, but in general, we've seen, not just consumer spending rise, which is good for retail, et cetera, but also a good indicator of the economy, but also real construction spending, which which actually was negative just going back into 2023-24. So we have seen that turn around as well. So on an inflation adjusted basis, the consumers are out there and they're buying more retail goods, and that's pretty important. Overall in the economy, then, I've already said we're moving into about a 1.4% growth rate going into next year nationally. You can see we had a setback in the second quarter of this year, but we expect that economic growth will now kind of accelerate on a very modest basis as we go through the remainder of this year and into 2026. 1.4%, by the way, for 2026. That's maybe about 40 or 50 basis points lower than expectations for U.S. growth. But the U.S. market itself is very bifurcated right now. It's the relatively higher rate of economic growth. It's still a bit of a soft landing as well, is being elevated a bit by AI investment and in a couple of sectors, and also some very slow sectors right now. So we'll see how that will evolve. I think some of those slow sectors will have some impact on our ability to grow our economy as well. And then just briefly, I've shown a picture of how that falls out regionally. I won't go in through all of that, but obviously in the West, where the commodity cycle is driving economic growth right now, we see stronger activity both last year and this year, and still relatively outperforming activity, at least from a national perspective, into 2026. Of course, weaker activity is in central Canada. And I'll say a thing or two about employment. One of those being that unemployment rate is elevated right now, and we have also my light's going off, and we have also had on and off again growth on a month-by-month basis. But we have still created more than 200,000 net new jobs in the last year. And in a pre-pandemic benchmark, that's actually a pretty good number. So, the labor market has excess capacity in it for sure right now, but it is not, that stressed going into 2026. I do have an illustrator on the right-hand side saying that one of the things we're concerned about is youth employment in particular, where we have seen those come down. That has an implication on labor markets, that has an implication on consumer household spending, et cetera, and it has implications on the office market. And then I'm just going to move ahead here a little bit because I want to move into some observations on the housing market and to provide a little bit of insight into some of the things that Altus is measuring in terms from our data and where we think housing is going. The housing market right now is very bifurcated. There's a housing crisis on right now. Is that true? Perhaps. Is the housing market really stressed right now? For sure it is in some segments, but there continues to be a lot of housing demand. Consumers are demanding housing. And one of the ways we know that is because the resale market is performing well. It's not on fire, but it's not, spinning out of control. In fact, we're tracking last year's sales on a, month by month basis pretty closely. We'll actually probably come in around 500,000 sales, just like we did last year. And I've actually added a line to that right-hand illustration as well. I've added 2019. It's a kind of a pretty good pre-pandemic benchmark. We are really on track on that pre-pandemic benchmark. What the housing market doesn't look like is the weird patterns we saw through the pandemic and post-pandemic period, but it's back on track now. And people want to buy homes. There is housing demand, and that's important. And on a regional basis, I won't go through all of these, but there has been some stress, particularly in BC and Ontario earlier this year. Again, those are markets that were probably unduly impacted by the chaos of the early Trump announcements, et cetera. But even those markets have kind of gotten back on track. And we've got other regions which actually have been outperforming, like Quebec has been outperforming recent activity this year, and as does the East as well. Good news on the resale market housing side. And it hasn't always been that way. We had this major price adjustment in almost all markets back in during the interest rate cycle. That's a stylized fact of the market. But those prices have now adjusted. They are now relatively stable. And I expect they will stay stable going in through 2026, national number being more or less around zero. We might still have some negative price growth, more adjustments coming in some of in Vancouver and Toronto that you're seeing in there, but some of those other markets starting to gradually pick up on the price side as well. But the new home market has been much, much different. I'm illustrating right now GTA numbers. These are the housing sales numbers that Altus Group collects on behalf of builders and disseminates through our Altus Data Studio website. And they are dismal right now. I mean, from last year, we've seen both, whether it's single family or whether it's apartment, we've seen sales down, in the 50-60% range just from last year. But if we compare it to the peak of 2022, where we, had almost 45,000 sales in total, those sales are now down 90% in both single family and in the condominium apartment sector. That's putting a tremendous amount of stress on the builders in this market, and I'll say in a second across Canada as well. And it's really upending the way we deliver new housing to market, the kinds of financial models we have, the role of affordability and the role of government charges, et cetera, and that it's raising all sorts of very important issues right now. And stay tuned as we continue to try to address those in the months and quarters ahead in order to try to fix this. On the right-hand side, I just want to say we have had, a slowdown in population growth in the GTA and nationally, but even with that, I mean, my expectation is that we still require about 30,000 units in the GTA in the next, over the next decade or so, a couple of decades on an annual basis. So for the next 10 years, for instance, that's about 300,000, net new homes in this thing. We will have to have new projects coming through the pipeline in order to deliver that. And also, even though population growth has slowed down, this expectation for units really incorporates the idea that those price adjustments we've had and that might still be coming forward, it's going to be bringing some additional relief on affordability and releasing a bunch of pent up demand. And that's going to be important in that market. Just briefly on a national basis, I won't go through each of these, but the story is similar in almost all major markets for new construction. So here's the condominium market down on a year-over-year basis in just about every market that Altus tracks across the country. Here's the single family market, same thing, down dramatically both this year and in many cases last year in just about every market that we track across the country. I mentioned population growth already, and I'll just mention again with a little bit more detail that what we're facing with the new immigration policy is dramatically lower levels of population growth, not just this year, which will probably be a population decline coming forward in Canada, but also over the next 10 and 20 years, we're going to see a lower pace of population growth. And that's what we're going to have to adopt and adapt to going forward. Good news is it may help to fix the housing market and affordability. The challenging news is that we will have to be very careful to make sure that the product that comes forward in the housing industry will better match the slower pace of growth and also where the growth is. For example, the growth in the last 10 years has been dominantly in that 20 to 35 year group, which drives apartments and rental, but the dominant amount going forward is in the more the 35 to 50 year group, which is looking for single family homes and ownership. And of course, the downsizing market continues to be dominant as well going forward. Just quickly then, in terms of wrapping up my forecast, this is actually going to be a pretty strong year for starts. That seems counterintuitive with the sales numbers I've shown you, but there are long lags in the process. The starts that are happening this year are sales that took place in the frothy period of 2022 to 2023, and they're still getting going, and they're getting going in many of our markets. And we're going to end up with in excess of 250,000 housing starts nationally this year, and it's going to fall off a little bit next year, but the fall off is not even next year is not going to fully reflect the decline in sales yet. That will come ahead, but we're still seeing a relatively robust housing environment, at least for the next couple of quarters ahead. Just briefly across the country, that does differ a little bit by center. Housing starts are falling much more quickly in the GTA right now than they are elsewhere. Of course, in Calgary, they're up this year, and will probably moderate a little bit next year based on this year's sales coming down. And then the last thing I just want to say, just before I turn it back over to Alice, is to remind us that purpose-built rental continues to also be a dominant component of the new construction sector. It's now representing about 70% of the new apartment construction that's coming forward, that has come forward this year. And those numbers, buoyed by purpose-built rental, that have actually put the apartment starts up, even though the condominium sector, you can see, is providing a lower and lower contribution as we go forward. So Alice, I'm going to turn this back over to you, and thank you everybody else for attending today.
Sure, thanks Peter for that snapshot. I know the housing market in Canada really gets a lot of headline attention, and kind of being able to take a deeper dive and point out some nuance, I'm sure the audience really appreciates. Earlier in your presentation, you pointed out the strength of the consumer. Earlier this year we heard a lot about consumer confidence being low coming into the year. So nice to see that's trending in the other direction. The retail practice area is my main practice area of valuation here at Altus. And I'm kind of seeing that in our valuations as well. Steady uptick in retail sales, particularly in top centers, newer centers, grocery anchored centers. This has been occurring in nominal terms for the past several years coming out of the pandemic, but really want to point out that growth was largely inflationary. And you pointed out that now that inflation's more or less under control, we're seeing that real growth turn positive, and landlords now have a little bit of leverage to start increasing rents, and we're really seeing that in stronger cash flow projections in almost all retail formats. Investors seem to have noticed this trend as well. There's been lots of activity, especially in the enclosed mall space this year. Demand for retail in really all categories. And maybe that's a good segue. Speaking of investment activity, I will pass it over to Ray Wong. He's going to cover what he's seeing in the real estate markets and his take on, transactions and sentiment going into 2026. So
great.
Please welcome Ray Wong.
Thanks, Alice. Let's get right into the slides. Basically, the only thing that was constant in 2025 was change. And a lot of sort of uncertainty based on the uncertainty in the marketplace that caused a lot of pause or delays with respect to the markets. But it's also highlighted a number of sort of structural weaknesses in the Canadian marketplace, such as the issue with productivity immigration, trade, and Canadian business environments. All that sort of contributing to the confidence in the market, consumers, and the economic trends. But what we've also seen is a bit of a lag with respect to the announcement and changes and the impact onto the real estate. So when you look at the overall cap rate, so this basically is our investment trend survey. So this is surveying close to about over 400 of our clients to get their take on where sort of values, what type of product is active. So this is the survey of the cap rates, and this sort of epitomizes the uncertainty in the marketplace with a pause. And this is basically a calculation on transactions, which there has been a limit, but as well as the current listings on the marketplace and what investors are looking to, what they were preparing to pay or the price. So the challenge we have with the market right now is that bid-ask expectation between sellers and buyers. So when you look at where the investors are looking to purchase, and this is not a big surprise with respect to where the assets are, and it's more of a chase to yield. So yeah, the most popular markets remain with Toronto, Vancouver, and Montreal. But the challenge is finding the product, especially with food anchor retail and with res, with respect to the market. So what investors are looking for is still value, and as well as the returns, and they're looking at cross segments of the market. So we look at the first, almost year-to-date Q3 on investment activity, that we are down compared to a year ago. And part of that decrease was also based on what happened in 2Q 2024, where we were about to see capital gain tax changes, which didn't really happen. So I don't think we're going to hit the levels of the 2024 numbers, but again, it remains to be seen. So when you look at where we're at year to date, we're at 34 billion, and we're quite a bit lower than the 56 that we hit last year. And when we're pretty well down in a lot of the markets, or all the markets across Canada, with Vancouver and GTA and Montreal still the bulk of the investment activity in the market. So when you look at the overall by asset class, and every asset class is basically down, with the exception of hotel. And hotel has gotten a lot of attention this year just because of Canadians choosing to do a staycation and rather travel in Canada, and increase occupancy levels of hotels. But the most popular products remain with respect to industrial apartment, and as well as what Alice mentioned earlier on the retail front. So when you look at some of the challenges, and this speaks to Peter's point with regards to the housing sector. So we've had quite a bit of distressed transactions over the last 18, 24 months. And a lot of this is more of a reflection of a little bit of the inexperienced builders that failed to pivot and change with the changing demand, and as well as the certain price points that they purchased the real estate at, and whether or not, based on the interest rates, whether or not they can hang on, or it was also based on their investors that wanted to sort of pull out at a certain stage. So this will probably likely continue going into next year, with respect to the lag in the marketplace, and as well as with the housing market sort of starting to come back a little bit, but this we probably will see increase distress sales going into next year. So I'm going to turn this over to Rob, and Rob's going to share insights from our advisory team and discuss some of the factors that are driving valuations. Rob?
Thank you, Ray. It's going to be interesting to watch transaction volumes moving forward, particularly as we get towards the end of the year, which is typically a busy time for closings. Thank you, everyone, for joining us today. We're going to jump off from Ray's discussion and talk about valuations and how the trends that we are tracking are being translated into appraisals. All right, so on the screen, we're looking at our Canadian valuation data set. So this is comprised of over 1,100 same-store assets that are valued quarterly. So that is to say that each asset is appraised every quarter by an external appraiser. And from this data set, we have removed land, development, specialty assets, and assets over $500 million. So the blue line in the chart shows the quarter-over-quarter capital value change from pre-COVID through to Q3 2025. And the vertical bars then break that value change into two components. So that is the yield impact. So that is shown in the green bars, which quantifies the amount of value change that's due to pricing. So that's cap rate and discount rate changes. So for example, at the onset of the pandemic, values came off about 3.5% right away. And of that, approximately 25% or a quarter came from pricing changes. And then during the COVID recovery that followed, we saw compression in cap rates, and the green bars start to show accretive to value. And then in the first half of 2022, pricing impact started to have a significant drag on values. This dragging continued for about 9 quarters until Q2 2024 and coincided with the Bank of Canada's tightening of monetary policy. And then the blue bars reflect cash flow impacts on value. So that is the change in cash flows resulting from changes in cash flow forecasts from one appraisal to the next. So this includes everything from contractual items to market assumptions. So you'll notice the tall blue bars throughout the COVID recovery from Q4 2020 to about Q2 2023. So this run-up was fueled by rent and growth assumptions, primarily in industrial and residential assets. And then eventually cash flow growth slowed and then turned negative at the end of 2024 as market-wide fundamentals began to soften. And we've been in somewhat of a holding pattern for the last 5 quarters, with overall value changes remaining relatively flat. And in Q3, we saw a continuation of this trend without any new transactions indicating a change in direction. This slide that we're looking at here decomposes those value changes we saw on the previous slide into their component asset types. So starting with office, which is shown in the top left of your screen, we see negative value changes since the onset of the pandemic. Cash flows have consistently been a drag on values. This is resulting from lower occupancy, lower market rent expectations, higher vacancy allowances, increasing deal costs. And the decline in office values has been improving or slowing in decline since about Q4 2022. We are seeing strength in Class A assets, and we are watching pending transactions that might indicate a shift in expectations, pricing expectations going forward. So over to retail, which is shown in the top right of your screen. So this was the most negatively impacted at the start of the pandemic, and in recent quarters had been the best performer. This performance is concentrated within open format grocery anchored retail, not necessarily within mall category. Within grocery anchored retail, we had increasing rent, increasing growth expectations, and then high demand from investors, which has pushed up valuations. Industrial, which is shown in the bottom left quadrant of your screen, boomed during the COVID recovery. Growth in cash flows slowed at the end of 2023 and has turned negative as softness hits the industrial leasing markets. We've seen market rents rolling backwards, slowing rent escalations, and then couple that with the introduction of leasing incentives and other deal costs, making getting deals done more expensive. But not all industrial is experiencing softness to the same degree. So we're seeing softness in medium bay, large bay, but smaller bay industrial, which is expensive to build, is remaining somewhat resilient. And then residential values, shown in the bottom right chart, have been steadier than other sectors. Softness in leasing markets, which have been most acute in Toronto and Vancouver, has started to turn residential appreciation negative. So valuations are reflecting rental incentives and slowed growth rate expectations, as well as slower tenant turnover projections. All right, so turning to our next slide, I wanted to illustrate the spreads to our discount rates over 10-year Government of Canada bonds. So the way to read this chart would be looking to the far left, pre-pandemic. The industrial discount rate was about 600 basis points above the Government of Canada bond, the 10-year bond. Keeping in mind that going into the pandemic, bonds were already low, circa 1 to 1.5%. Then the pandemic happened, and then bonds went even lower, and discount rates pushed up due to liquidity concerns and other risks, and spreads blew out further. Spreads started to come down at the end of 2020 as bond yields started to rise, and certain assets saw compression in their discount rates. And then inflation started to pick up, and bonds started to rise, and then real estate spreads compressed before starting to expand again in the second half of 2022. Today, spreads are somewhat tighter than they have been in the years leading up to COVID. Bond yields remain volatile, and the expectations for most central banks is that they're going to trade within a range similar to where they are now for the next 12 months. So if we expect spreads to revert closer to pre-COVID averages, then there could be some room for further decompression unless we saw bond yields move lower. And then the last slide that I wanted to leave you with is showing the cumulative value change across those four main sectors. So the black bars show the value change in the last 12 months. So residential and industrial are so close to being flat that you can't even see the bar in the chart. They are actually slightly down year over year. Office is also down over the last 12 months. And then retail is the only year over year positive contributor. And again, that's contributed to by the open format grocery anchored retail. So the yellow bars show the value change from what we're calling peak. So that's the start of the Bank of Canada tightening of monetary policy. But it's not necessarily the peak value for that specific sector. So residential and industrial remain higher, while office and retail are lower than what we're calling peak value period. And then the blue bar shows the cumulative value changes since the pre-pandemic time. And the standouts there, obviously industrial and office. So industrial values are up 60%. To put another way, for any given asset or for the overall data set, industrial values for a specific property are 60% higher than they are today relative to pre-pandemic. And then conversely, office values are down 30%. So we could drill down into that a little bit deeper and find bifurcation where better quality assets would be down less and lower quality assets would weight that 23-quarter value change a little bit lower. So going forward, it's going to be interesting to see how long it takes for retail to move above that Q1 2022 and pre-pandemic levels. And similarly, what trajectory office will take is also going to be something that we're going to watch. But certainly, I would expect the Class A assets are going to outperform other categories. And with that context in mind, I'm going to bring back Ray Wong. He's going to discuss availability, leasing, and supply in the office and industrial markets.
Great.
So Ray?
Thanks, Rob. And just adding to, I'm not sure if it's, whenever I see that 60% increase in value chart for industrial, it shows great returns for that type of assets. And the challenge right now on the industrial front is, again, it's that lag on policies and tariffs that we thought that there was going to be a little bit more challenges in the industrial sector this year based on what was happening at the beginning of the year. And now we're starting to see some of that sort of impact of some of those changes. In the last few days, we've seen the announcement with Stellantis moving the production of Jeep down to the U.S., as well as that with respect to Ingersoll and GM and the EV trucks sort of stopping production. So again, there are discussions of bringing back other different lines, but we've already seen some of those challenges with some of the manufacturing that are starting to take a hit just because of they're starting to feel the increased costs, as well as a bit of a softness with the economy, with consumers. So for the most part, for industrial availability rates, it's sort of flat, but we're starting to see the numbers move a little bit, and partially the stabilization of the industrial availability rates has been sort of the pullback of new construction. New construction is still hitting, but those are projects that already sort of started about 9 to 10, 18 months ago. But new supply is basically dropping off. Sublet was sort of an impact last year, mainly due to large retailers and sort of the third-party logistics companies sort of pulling back on their space. And it's still a bit a factor, but not as much as you would think, with companies perhaps pulling back. But this is an area that we're going to be watching going forward. With respect to average rents, it's still flattening, and with and again, these are asking rates, whereas we're sort of actual rents. So, and tenants have a little bit more choice in the marketplace compared to the last 3 years. So, and Rob mentioned the bifurcation of the sector, that the newer product are getting higher rents, but we expect this to sort of flatten out a little bit more going into next year, with perhaps, if we do see rent increases, it'll be minimal, between 1% and 3%, and as well as possibly a slight increase in tenant inducements, especially with some of the larger space remaining on the market a little bit longer. And when you look at the overall industrial lease transactions, so it's relatively, it's in the same range with respect to the demand for space. And what we've seen in the last few years was that catch-up space with large bombers, with logistic companies. Now we're starting to see a little bit more demand in the medium to large bay sizes, and this will probably continue. But again, it's, with the exception of Calgary, where the average leases are a little bit larger, everything else still remain into the anywhere from probably the 50 to 100,000 square foot range with respect to average leases. And when you look at this is what we talked about with the under construction numbers, and they have come back down a little bit, and there is still a little bit of spec construction, but most of this is either started or design build. So we see this sort of flattening out even more going to next year, and whether or not there will be a change of with the markets, that this will keep the overall availability rates down. We turn to the office availability rates, and this is the biggest story, and basically with respect to return to the office requirements. And that's something to keep in mind. A lot of the activity that we're seeing right now is adjustments by banks and others that are trying to accommodate employees coming back in and leasing more space. So it's not necessarily new demand, but a lot of space that is facilitating to the back to the office, and as well as we're probably going to see a lot more of this, especially going forward into January 1, when there's increased mandates from 3 to 5 days for certain companies. We look at the Class A vacancy rates. They continue to sort of level off but decrease. There's still a bit of a lag based on the number of mandates, especially in Toronto and Vancouver, for office space, and for that to take place. So we expect the downtown office vacancy rates to continue to come down for the remainder of this year and going into next year. when you look at the select Class A vacancy rates, and these are your basically your AAA office vacancy rates in both Toronto and Vancouver, they're under 2%. So the challenge right now for tenants, and we're seeing this with the leasing activity, the average leases or size is actually more for Class A compared to the B and C space. So this is where you're seeing some competition with some of the tenants in securing some of the space. And for the select buildings that we're seeing definitely a decrease in the tenant inducements, but as well as certain firms being outbid for certain locations. So again, it's going to be that impact in the finding large contiguous space, and eventually we're going to see the impact on the A space that is slightly less amenitized compared to the A. But what we're also finding is that a lot of that demand is for finished space rather than the raw space, especially when you look at the cost of some of the tenant improvements. With respect to new supply, again, there's about 10 projects in Vancouver, and they're slightly sort of smaller in the size compared to the 7 projects that are continuing with Toronto. But within the next 3 to 5 years, we probably will have a shortage in the select A buildings, and we'll probably see a little bit more announcements in the marketplace. So to sum up, what we're finding this year is that a lot of the companies or developers, owners were sort of on the sidelines, right? So after a year of uncertainty and caution, the fundamentals are okay. The economy won't be as bad as earlier predicted or expected. Interest rates will continue to moderate. So we're okay, right? But in 2026, expect the commercial market to gradually sort of step off the sidelines, and with a moderate increase in activity. Still, again, we're still navigating through uncertainty, but we're at least more certain that uncertainty will still occur, but try to deal and pivot with a different way. And likely won't be as euphoric compared to the last few days with respect to the markets, but it's getting better, and nonetheless, right? So go Jays, and I'll turn it back over to Alice.
Thanks, Ray. I'm sure everyone smiled a bit with the Jays slide insertion there, but really bringing back to what you just said, speaking with my institutional clients recently, really hearing same thing. Seems to be they're more actively looking at opportunities, they're more successful at raising capital, and I think maybe with equities performing so well in the last couple, 6 months, 1 year, that allocations are starting to shift perhaps back into real estate, and that'll be an interesting thing to watch going into 2026. Ray, is that consistent with your crystal ball?
Yeah, I don't think it could get any worse. And the thing is, it's costing money, capital, for money to sit on the sidelines. And I think everyone wants to. They understand the uncertainty in the marketplace, but I think the thing is to move forward and to really to be able to look at the various opportunities. Again, it's not like everyone has stopped. It's basically they're looking at definitely at the core assets, and is bifurcated in almost every product type. But I think everyone's sort of itchy to go forward and execute on some of the transactions despite some of the uncertainty, and the ability to weather the storm.
And Rob, is that consistent with what you're seeing and hearing from clients?
So I would agree that we're likely to see a pickup in transaction activity, but I do think that groups are going to be a little bit more diligent. I think we're going to see more stringent underwriting and stress testing as they look at different opportunities. But I am sensing optimism and hearing from groups that they're coming off the sidelines.
Okay. All right, maybe now is a good time to bring back Peter and we'll start the Q&A session. I've got two questions in the chat that are kind of neck and neck, both relating to the apartments and condominium market. So let's start there. The one at the top, this is for Peter. With the sharp decline in new condominium sales across the GTA, when do you anticipate the condo market will begin a recovery? The second part of this question is, what level of price appreciation would you expect to follow? So what is your crystal ball to this?
Yeah, I think that's a great question, and it's obviously on the minds of a lot of developers and others right now. I described a picture where there is housing demand out there. Resale market is certainly picking it up. Resale market has had a big price adjustment. I think on the new construction side, one of the challenges that we face is that the product is still priced a little bit above market. So it may be an availability of the right priced market. Maybe, once we see a kind of a regular price coming forward in the market of more like, $700 to $800 a square foot as opposed to $1,100, that's going to be something that stimulates the market a little bit. So that's certainly part of it. The other part of it, certainly in the GTA and in the Vancouver context, is that the model whereby a lot of sales go to investors that then get flipped over to end users ultimately has kind of hit the skids right now, because investors don't see that kind of potential value uplift that comes through that model. So I think that the market's going to come back as soon as we have the right kind of product in the right kind of projects that's going to appeal to end buyers. And that will tend to be, at least initially, smaller projects that can be delivered to market more quickly, with larger units that appeal to that demographic shift I talked about, and again at price points that appear to be more in line with what the market is signaling right now. When that's going to be, I don't know. I think that we're going to have a lot of challenges, continue to have a lot of challenges through to 2026, at least in Toronto and Vancouver. I think other markets across Canada will probably see that transition happen more quickly.
Okay. And maybe since we do have some time, we'll keep on that theme with purpose-built rentals on a very high percentage of housing mix. Will this create excess supply in the market, while young buyers will still want to go for single-family housing? Will there still be an imbalance in years to come?
We'll see how that plays out a little bit. I mean, I described a kind of a demographic shift that has moved away from young buyers. That is true. But there's a couple of caveats you want to kind of keep in mind there. One thing is we still have the downsizer market, which also, fuels purpose-built rental, although typically larger units. And also, even that kind of, family creation side, there is an opportunity for kind of larger ground-oriented apartment units that can feel that. And the rental market has traditionally always also played a role in that market. So I think we've got a lot of opportunity there. Whether there's going to be an excess supply of very small units or not really depends on how quickly the pricing of that supply unleashes a lot of the pent-up demand. So we may not have a lot of growth of bodies of people who are in the ages of 20 to 35 over the next 10 years. Sure, not a lot of bodies. But those bodies who are in their parents' house right now and might be incentivized to move out of the house because of an adjusted rent, that's where a lot of our demand is going to come from.
Great. So Rob, you mentioned
on that point as well, we got to look at the shifts in housing, especially with that interprovincial migration of people the last few years. And you look at what's happening with Alberta based on affordability. So definitely Vancouver and Toronto are seeing some of those challenges. And the prices have moved up with respect to the Calgary marketplace. But when we look at affordability, it's a little bit more, it's better, especially on the secondary markets. And it's Toronto, Vancouver is facing some of those issues. But it's a challenge with some of the locations on some of the affordability is a lot more pertinent compared to some other parts of Canada.
Okay, Rob, you mentioned earlier in the presentation, industrial values up 60% since pre-pandemic peak. Do you expect values to revert to these levels, or is something structurally changed in this market?
Yeah, so the industrial run-up in values was quite spectacular, but it is hitting a soft spot as economic uncertainty sort of takes hold, and as future growth in the short term anyway, is expected to slow and vacancy rates tick up. So I think in the near term, there's going to be softness within industrial, and that's going to continue to weigh on rents. That's going to call into question near-term rent growth expectations and vacancy allowances until some supply is absorbed. Gross rents within industrial, base rents, taxes, operating have really escalated from where they were pre-pandemic, but I don't think we're going to see a significant retracement in rents and values. And in the medium to longer term, industrial fundamentals could still prove to be strong.
Ray, renewed optimism in the office sector seems to be getting a lot of attention. When do you think the next new office tower will be constructed in Canada, and maybe where?
Well, yeah, there's a lot of pre-leasing going on, but when you look at definitely for the larger buildings, I think it's definitely with respect to the Toronto marketplace. But I think for smaller buildings in the urban or downtown area, I think we probably will see Vancouver, because it's a little bit more faster to build something smaller rather than larger. So I think it's a race between those two, but I kind of like Vancouver just because of the size expectations of those buildings compared to Toronto.
Awesome. Maybe I'll just look at one more, and I'll take it myself because it's kind of an oddball, but I am looking to purchase a grocery anchored retail plaza. So we do not have a brokerage affiliation here, so I can't help you with that question, but I think it does speak to a larger theme in retail. There's just lots of people interested in it. Ray's survey suggests it's still the most preferred asset class out there, but not a lot of quality opportunities coming up for sale. And then when they do come up for sale, we see lots of bidders, lots of different groups coming to the table. We're also seeing longer closing periods, at least in the GTA. I think that differs a little bit market by market, and Vancouver seems to move a little bit faster, but it's really becoming an interesting thing to watch when bid-ask spreads are really going to close, and we're going to start to see some things shake out there. We have 3 minutes left. So I don't know if we want to do one more question. Time for that.
Alice, I just happened to see that question on there about remote work or whatever, and I wanted to just mention one aspect of it. I know Ray has already addressed, how it's impacting absorption recently, but I think it's important to remember that we've had a much longer time frame where increased flexibility of work has been coming into place. It just happened to be that the pandemic sort of accelerated that. But the pandemic also taught us that it's something that does work, that hybrid work does work, and we've spent a few years now getting to the right level. But I think what's going to be most important going forward isn't that it's just going to be a continuous line back towards 100% office, as one company or one government department brings a back to work order. That's not the way the future looks. The way the future looks is that when the labor market is weak, like it is right now with high unemployment, that's when you're going to see more back to work mandates. And when labor markets get tight again, which they will pretty quickly, that's when we're going to see more flexibility. So we're really, it's more going to be a cycle that we have to be behind. And then the last thing to just say is that the remote work is part of the issue about slow absorption in the office market. A big part of it has been the efficiency revolution of space. That is ongoing. that's something that we're going to see over the next 10 years continue to evolve.
Well, I think there's a certain amount of permanency with office. I don't think office is going away. And I think it's an important part of companies, especially with the interaction. And to get through this sort of, he set up a meeting just to have a phone call. It doesn't really work, but you need those accidental discussions. And that's where innovation takes place. It doesn't take place working from home. So I think that's going to be continue to be an evolution going forward. But I kind of like the direction where the office market's going. And I think we're going to see some more changes to that area. But I think we're probably going to see more growth and more innovative space come up. And I agree with Peter, it's not going to be the traditional office space, but I think we're going to see a different type of demand going forward.
Great. That takes us to the top of the hour. So thanks again, everyone, for attending today's webinar. We will follow up with questions that we weren't able to respond to today live. As a reminder, a copy of the recording will be sent out by email. So for those of you experiencing the freezing that was also mentioned here, we'll make sure to get you a copy of this presentation, and stay tuned for that later this week.
Thanks, everybody.
Thank you, everyone.
Thank you.